Hey everybody, Mike Desepoli, Heritage Financial Advisory Group. Thanks for tuning into the 2017 halftime report. It's really hard to believe we're already at the midway point of the year. I want to take a couple minutes here today and give you a couple of the key points of what we saw as catalysts in the first half of the year, what really got us to where we are now, and what we're looking at as we move into the second half of the year to see if these trends in the market can continue. Most people would not have expected the markets to perform as well as they have under the new administration. There was a lot of fears that people had about policies that be put into place that could restrict the economy, but so far there's not much that's been done in Washington, D.C., and the economy has continued on the course of expansion as it has over the last couple of years. Some of the things that we see driving the action in the markets, number one, would be consumer sentiment and small business optimism. Both are indicators about how small business owners and consumers are feeling about the future of both the personal and the global economies. If people are feeling better about the economy, they're more likely to spend money, expand their businesses, increase hiring, and the overall effect should be expansion for the U.S. economy. Second thing that we see driving markets higher is money flows from international places into the United States. Largely probably because people expect there to be a corporate tax cut worked into the tax reform plan down the road. And if people have money over shores or international corporations specifically, they're trying to bring that capital here into the United States as they see us as the best opportunity to invest right now, particularly with a 15 to 20% tax cut coming down the pipe. So that's something we see as a tailwind pushing markets higher. And the third is rising corporate profits. A lot of the stocks that we've owned in the first half of the year performed very well. They've reported earnings quarter after quarter that have exceeded expectations. And that's a good indicator for where the U.S. economy is headed. As we look at the companies that operate here, as their profits continue to rise, that's a good indicator to us that they're healthy and stable and should continue that momentum going forward. Moving into the second half of the year, there's a couple things that we're keeping our eye on, as well as some opportunities that we see in the markets. Number one, we're keeping our eye on interest rates. Obviously, we've had two nominal interest rate increases so far this year. There's debate whether there'll be one or two more throughout the course of the year. We're of the belief that there'll either be none or one, if any. But either way, the interest rate increases are very nominal. They shouldn't have much of an effect on the markets moving forward. But we'll keep an eye on that and see how it'll impact the markets as it comes. The second thing is the political gridlock in Washington, D.C. Obviously, there's been not much done down there since the Trump administration has gotten into office. There's been a lot of resistance from both sides and lack of agreement on pretty much anything. So that's something that obviously is a threat to the administration's agenda. We want to keep an eye on that to see if they'll eventually be able to get through health care and get onto tax reform, which businesses are obviously very excited about. If they're not able to get anything done, of course, that could be a risk to the markets, and that's something we'll keep an eye on, but we don't see that as the point that we're at, just yet. Here we are at this point in time. Third thing we're looking at is something called emerging markets. It's something we have in the portfolio right now. It's actually markets outside the United States, markets that are growing at a pace, 2, 3, 4 times that of the United States. You remember, we are the greatest economy in the world, but we generally grow at 2 to 3% per year, and there's economies out there that grow far quicker because they're younger, more emerging economies. We look to these economies to present investing opportunities, and this is an area that we see second half of the year really could present a lot of value. We'll likely increase our exposure in emerging markets as we move into the third quarter here. So those are just a couple things that we're keeping our eyes on. Obviously, we still think the U.S. market as a whole is the best place in town to invest. We'll continue to lean on our technology shares, our technology companies that have really driven our first half performance. A lot of these companies have performed exceedingly well, and they do so very efficiently with low human resource capital and low expenditure to do so. Thanks so much for watching this video. If there's anything you'd like to talk with us about, we're always happy to sit down and chat with you. Send me an email or give us a phone call, and we hope to see you soon.